This ETF has quietly outperformed a lot of investors' portfolios, yet almost nobody talks about it. While everyone focuses on ETFs like VOO and QQQ, this ETF tends to fly under the radar. Today, we're breaking down SCHG, what it is, how it works, and whether it actually deserves a spot in your portfolio instead of or alongside VOO and QQQ. So what exactly is SCHG? This is the Schwab US Large Cap Growth ETF. It's managed by Charles Schwab Asset Management, one of the largest and most established asset managers in the world. The goal of SCHG is pretty straightforward. It aims to track the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. This index is made up of around 200 publicly traded US companies, all of which fall into the large cap category and are selected specifically for their growth characteristics, things like strong revenue growth, earnings expansion, and market leadership. So instead of trying to pick individual growth stocks yourself, SCHG gives you a broad exposure to many of the biggest growth-oriented companies in the US market, all wrapped into a single ETF. One reason SCHG can work well inside of a diversified portfolio is the cost efficiency. The fund has an expense ratio of just 0.04%, which means you're paying only $4 per year for every $10,000 invested. That's significantly lower than many actively managed growth funds and even cheaper than some of the competing growth ETFs. And while it does pay a dividend, it's relatively small, sitting at 0.3%. And that's intentional, as CHG is built first and foremost for that capital appreciation, not for generating meaningful dividend income. Before we get into the performance, it's important to understand what SCHG actually holds, because the structure of this ETF explains a lot about both its upside potential and its volatility. From a sector perspective, SCHG is heavily tilted towards growth-oriented industries. Nearly half of the fund is allocated to technology, with roughly 15% in communication services and about 13% in consumer discretionary. Altogether, these sectors dominate the portfolio, which immediately tells you this ETF is designed to capture growth, not provide defensive exposure. When we zoom in on the individual holdings, SCHG is led by some of the largest and most influential companies in the US market. At the top of the portfolio is Nvidia, which makes up just under 11% of the fund. Right behind it are Apple at roughly 9.7% and Microsoft at 8.7%. So while there is some concentration at the top, it's spread across multiple mega cap leaders rather than a single stock dominating the fund. Beyond the top three, SCHG continues to hold many familiar names such as Amazon, which comes in around 5%, Meta, Tesla, and Alphabet, each sitting between that 4 to 4.5% range. You'll even see some companies like Broadcom and Eli Lilly rounding out the top 10. Altogether, the top 10 holdings make up close to 60% of the entire ETF, which means SCHG is fairly concentrated compared to broader market funds like VOO. That concentration is a bit of a double-edged sword. When large cap growth stocks are performing well, SCHG can significantly outperform, but during periods when tech or growth stocks struggle, the swings can be a bit more pronounced. And this concentration in high growth, market leading companies helps explain why SCHG's historical performance has been so strong, which brings us directly into the returns. Now let's talk about the historical performance, because this is where SCHG really starts to stand out. They were first brought onto the market in late 2010, which gives us over a decade of real world data to analyze. Since its inception, the fund has delivered an annualized total return of roughly 17%. And when we say total return, that includes both the price appreciation and dividends reinvested. To put that into perspective, if you had invested $10,000 back in 2010, that investment would be worth around $110,000 today. That's more than a tenfold increase, driven mostly by SCHG's heavy exposure to large cap US growth companies during a very strong growth cycle. Now, if we zoom in and shorten the time frame a bit, the story stays pretty consistent. Looking specifically at the performance throughout 2025, SCHG returned approximately 17.7% on the total return basis. That's very much in line with its long-term historical average, and it shows that this hasn't been a one-off stretch of outperformance. The fund has continued to deliver strong growth results even in more recent market conditions. This kind of consistency is important, especially for long-term investors, because it reinforces SCHG's role as a growth-focused ETF designed to compound capital over time rather than relying on short bursts of performance. Alright, now let's compare SCHG with two other very popular ETFs, QQQ, which is well known for its large cap growth focus, and VOO, which tracks the S&P 500. Using a total real returns calculator, we can see that all three ETFs follow a very similar overall path throughout this time. The peaks and dips tend to line up pretty closely, especially during major market events, but the returns are slightly offset from one another. When we look at the long-term numbers, QQQ comes out on top, delivering an annualized total return of roughly 18%, followed by SCHG at 17% and VOO at approximately 14.5%. That performance gap isn't random, and a big part of that comes down to sector exposure. VOO has a much broader diversification and significantly less emphasis on technology, while both SCHG and QQQ are far more concentrated on growth and tech sectors. That higher growth exposure has historically translated into stronger returns, but also higher volatility. I was particularly interested in understanding why QQQ managed to beat SCHG over time, so I put both of them into a head-to-head comparison tool. One of the first differences that stands out is cost. QQQ has a higher expense ratio of around 0.2% compared to SCHG's much lower 0.04%. While lower fees are generally better for investors, that difference alone doesn't explain the performance gap. The more meaningful difference comes from the sector weightings. When we look at the two ETFs holdings, they both have pretty similar large cap growth companies. QQQ leans a bit more heavy on certain technology and communication related sectors, whereas SCHG is a bit more diversified. Now, how might SCHG fit into a portfolio? For investors who already hold a broad market ETF, such as VOO, SCHG could be used as a growth tilt. Instead of relying solely on the S&P 500's blended exposure, adding SCHG could increase the weight towards companies that are reinvesting aggressively into future growth. This could enhance returns over time, especially across long time periods and during those strong growth cycles. SCHG could also pair well with some income-focused ETFs. For example, combining a growth ETF like SCHG with a dividend ETF such as SCHD could allow investors to balance capital appreciation on one side with income stability on the other. Growth drives a long-term portfolio expansion, while dividends can help smooth out some of that volatility while providing some cash flow. Ultimately, SCHG makes most sense for investors with a long time horizon, a higher tolerance for volatility, and a primary focus on total return rather than income. If you found this breakdown helpful, make sure to leave a like on the video and subscribe for more ETF comparisons and long-term investing content. And let me know in the comments, would you choose SCHG, QQQ, or stick with the S&P 500?